So if you have like a prior understanding of the Excel models, then this just kind of explains further how it's actually practiced and like how you look at it. Kind of, and it explains a little better. Share. Okay, we're gonna go back to, go to this one. All right, everyone. I believe you can hear me now. So today, we're gonna watch these two videos. First, we're gonna watch Professor Damo Darren. I always forget how.
This is the first in a series.
So, the first video is gonna be estimating growth, and I'll let him get to it.
So we've got discount rates nailed down. We have the cash flows. This is where the rubber meets the road. Because so far we've been on familiar ground. We've been looking at financial statements and actual prices from the past to back up our estimates. Now I ask you the key question. How quickly will this company grow in the future? The first reaction that most people have is who knows? But in valuation, you have no choice. You have to estimate growth for the future. And you have two choices. Or you can try to estimate growth yourself. Based on what? Based on what the company does, how much it reinvests, and how well it reinvests. By the end of this session, I hope to convince you that the third approach is the one that is most consistent with intrinsic valuation. In the last few sessions, we've talked about the first two inputs into valuation, cash flows and discount rates. Today, we're going to talk about the number where the rubber meets the road, where most people start to get uncomfortable. I'm going to ask you about growth. And the reason people become uncomfortable is growth is in the future. In a sense, you're trying to play God, trying to estimate numbers. So let me lay out the three basic ways in which you can estimate growth. One is you can look backwards. You can look at the past. How quickly has this company grown in the last 3 years, the last 5 years, the last 10 years? That's historical growth. The second is you can outsource. You can ask somebody else. In particular, many analysts of value companies ask the managers of the companies what the growth is going to be in the future. After all, they should know their companies better than you and I do, right? Or they look at analysts, other people who look at the company, value the company, and look at their growth rates. And it's easier and easier to get those estimates now for many companies. But I'm going to argue for a third way of estimating growth. I'm going to make a basic thesis. Growth has to be earned. You and I don't have the power to go around endowing companies with high growth or taking away growth from other companies. So let's start with historical growth and why I'm skeptical about whether it's going to give you a sense of future growth. When you talk about historical growth, you think of a number. It should be the same number for every person looking at the company, right? Not true. It depends first on the measure that you're looking at. Whether you're looking at growth in revenues, growth in operating income, growth in net income, growth in earnings per share, you can get very different numbers. Second, it depends on the time period you look at the company. Growth rates over the last 3 years can be very different than over the last 5 or the last 10. In particular, if you pick a particularly bad year as your base year, so 5 years ago was a really terrible year, you're going to get a much higher growth rate. And third, and this again is going to sound like inside statistics, but hang in there. The growth can be very different depending on whether it's an arithmetic average or a geometric average. Geometric averages allow for compounding. They're much more realistic estimates of growth, but they can be either. That's why you can look for the same company on different data services and end up with very different numbers as the historical growth rate. There are a couple of general propositions about growth I want to emphasize. One is growth becomes meaningless when your company's earnings go from a negative number to a positive number. So if your earnings last year were minus 100 and this year it's plus 100, I can't give you a growth rate. I can tell you that last year was a good year, but I can't tell you what the growth rate is. Second, scaling up is hard to do. As companies get bigger, it's more and more difficult to maintain those really high growth rates. Something to keep in mind as you start to do valuation. As a general rule, I look at historical growth rates for companies I value, but I'm not bound by them. In fact, history suggests that a lot of growth rates are not sustainable. Companies that have maintained high growth in the past don't necessarily maintain them in the future. Let's look at the outside estimates for growth, managers and analysts. As I said, managers do know more about the company than you and I do, but they have two fatal flaws. One is they cannot be objective. What manager is going to tell you that he's a rotten manager and he's going to run the company into the ground? Management growth rates, therefore, might not be realistic because managers can't be biased about themselves or unbiased about themselves. They're definitely biased about themselves. Analyst growth rates are bad for a different reason. Analysts are focused on earnings per share. They're focused on the short term, and they often can't look past the short term. So if you look at analyst growth rates, they historically have not been very good predictors of long-term growth. So I've ruled out historical growth. I don't trust analyst estimates of growth. Where are you going to go for growth? Look at the company itself. For a company to grow over time, it's got to reinvest a significant portion of its earnings back into the business, and it's got to reinvest it well. In other words, to estimate the growth for a company, I've got to look at how much it reinvests and how well it reinvests. And effectively, if you think about fundamental or intrinsic growth, it can come from one of two places. It can come from adding to your asset base, making new investments and earning a return on those new investments, or it can come from efficiency. Let me take the first of those. When you add to your investment base, you can grow. And in fact, to see how much you can grow, I'm going to try to answer those two questions. How much are you reinvesting? How well are you reinvesting? I'm going to try to scale both. Again, to get away from abstractions, let me look at estimating what I call fundamental, sustainable, or intrinsic growth. They're all used interchangeably in equity earnings and operating earnings. So if you came to me with a company with equity earnings and said, what's the growth rate in the equity earnings in this company going to be in the long term? I'm going to look at the portion of equity earnings, net income, that gets reinvested back in the company. The simplest proxy for that is called the retention ratio. What is the retention ratio? It's whatever you don't pay out. So if you pay out 40% of your earnings as dividends, you got a 60% retention ratio. And the measure of how well you reinvest, I'm going to capture with your return on equity. So when you invest that equity in a project, what kind of return are you getting? So as an example, again, if your return on equity is 20%, with that retention ratio of 60%, your expected growth in equity earnings is going to be 60% times 20%, which is 12%. When I'm looking at operating income, I'm going to vary those measures slightly. Instead of looking at the percentage of net income that I reinvest, I'm going to look at the percentage of after-tax operating income that I put back into the business in net capex and change in working capital. Remember, we talked about those in the context of cash flows. Net capex here includes acquisitions. It includes R&D. Looking at that percentage tells me how much of the after-tax operating income goes back into the business. So let's say it's 70%. For every $100 in after-tax operating income, $70 goes back into net capex and change in working capital. To see how well you reinvest, I'm going to look at the return on capital. How much you're earning on your invested capital. So let's say you make 30%, you're a great company. 70% times 30% gives me a sustainable growth rate of 21% in operating income. Notice the key number in both these computations is that return number. In fact, if there's a single number in evaluation that I want to get right, it's that return number. Return on equity or return on invested capital. And that scares me. And here's why. It's a one number in valuation where I'm completely dependent on accountants. To see why, take a look at the definition of return on capital. In the numerator, you have earnings before interest and taxes or operating income, an accounting measure of earnings. You multiply by 1 minus the tax rate, often an effective tax rate, an accounting measure of taxes. You divide by book value of equity plus book value of debt minus cash. Notice book value. This is the first place in valuation where we talked about book value. Everywhere else in valuation, we use market values. We use market value debt ratios for cost of capital, market value debt to equity ratios when we lever betas. But when we do return on equity and return on invested capital, we look at book values. And here's why. We're looking at what was actually invested in these assets and trying to get a measure of whether they were invested well. So if you invested a little money 5 years ago and you're making great returns on those, I want to give you credit for that. The problem, of course, with using book values is every accounting judgment, every accounting discretionary call will also affect book value. Accountants can wreak havoc with book value. So return on equity and return on capital are key numbers, but sometimes you might have to go back and adjust what accountants have done and basically undo some accounting choices. You get to a reasonable measure of return on equity and return on capital. Spend the time though, it's well worth it. So that's the first way you can grow, is to add to your asset base and do it well. It is also possible, at least in the short term, to grow by becoming more efficient. Let me explain how. Let's assume you have a company with a return on capital of 5%, not doing very well, right? Let's assume that this company reinvests nothing, but improves its return on capital from 5% to 10%. The year that happens, it's going to double earnings, right? Because instead of making $5, you're now making $10. That's called efficiency growth. And it's going to be a function of how much your return on capital changes as a percentage of your original return on capital, which actually creates an interesting implication. Efficiency growth is more likely at companies with really low returns on capital for two reasons. You have more room to improve, and that improvement is going to create a much higher growth rate. So if your return on capital is 4%, you're a much better candidate for efficiency growth than if your return on capital is 20%. Bottom line though, efficiency growth is finite growth. What I mean by that is if you tell me you're going to grow for the next 3 years, the next 4 years by becoming more efficient, I can go along with it. But if you tell me you're going to grow forever with efficiencies, it can't happen. You can only become so efficient and no more. So the bottom line here is when you think about growth, you have to think about those two places you can grow, by taking more investments or by running your existing investments more efficiently. Sometimes though, when you value a company, you might have to go back to the top line, revenues. Why? Because your company might be losing money. Its margins might be changing too much. So here's a generic 3-step process if you run into a company like that. First step, estimate revenue growth. Predict what the revenues will be in the future. I'm not saying that's going to be easy, but that's your first step. Second step, estimate a target margin. Tell me what your margin will be once your company gets through its growth phase. You can look at industry averages. You can look at the company's history. Third step, tell me how much you will need to reinvest to get that revenue growth. To do that, I use a ratio called the sales to capital ratio. And it sounds fancy, but here's the way to read it. If your sales to capital ratio is 3, for every $3 in additional revenues, I would require you to invest $1 in capital. That'll allow me to estimate reinvestment. So let me take an example to illustrate this process. I'm going to use Sirius Radio in 2006. In 2006, Sirius had revenues of $187 million and was losing more than 5 times those revenues. Its operating margin was minus 420%. That's horrible, right? My task is to make Sirius a viable company. So here are the inputs I use to kind of bring Sirius into the future. First, I assume the small revenues become big revenues. So I assumed a revenue growth rate. Take a look at that column. You'll see my revenue growth rates are highest in the early years, and they become lower as you go through time. That's pretty much what you'd expect to see for young growth companies. It gets more and more difficult to sustain those high growth rates. The second input that drives this valuation is that operating margin. Look out towards year 10. I have an expected pre-tax operating margin of 19.57%. I got that by looking at Clear Channel, the most mature and most profitable company in this sector in terms of having been around a long time. I'm assuming that over time, Sirius's margins will converge on those. But I'm not going to be unrealistic. I'm going to assume that Sirius is going to lose money in the near term. So its margins will continue to be negative, but over time, the margins will improve to 19.57%. So 2/3 of my task is done. I've made small revenues into big revenues. And as the margin improves, those operating losses have become operating profits. Here's the third loose end. To get from small revenues to big revenues, I have to reinvest, right? How much do I need to reinvest? That's where that sales to capital ratio comes in. Every year, I take the change in revenues and I look at how much I need to reinvest using that sales to capital ratio. So that tells me how much I'll reinvest. And notice I'm not breaking it down. I don't know whether that reinvestment is going to be in the form of net capex, acquisitions, R&D. With young growth companies, it's tough to gauge. But that reinvestment gets subtracted out from after-tax operating income to get to free cash flow to the firm. Those 3 inputs, revenue growth, margins, and reinvestment, drive this valuation. And there's a danger when you do this. If you're not careful, you might create an unsustainable company in year 10. What I mean by that is you might reinvest too much or too little in this company. So to make sure I'm not doing that, here's the final check I run. When you have a reinvestment in a free cash flow to the firm, that reinvestment actually increases your invested capital each year. So since I knew what the invested capital was at the start of the period, I added the reinvestment every year to come up with my estimate of invested capital every year. I divided my estimate of after-tax operating income by that invested capital to come up with the return on capital every year. You're saying, so what? I took a look at what my end return on capital was, what I was estimating as a return on capital in year 10. What I wanted to make sure was that my return on capital in year 10 was a number I could live with, that I was comfortable with. I was okay with the number I got for Sirius. But let's add the number I'd ended up with would have been 3%. That would have been too low. I'd have gone back and reinvested less. If the ending number had been 300%, I was reinvesting too little. I'd have gone back and tweaked that number to reinvest more. So when you have young growth companies, use that process to keep your valuations in check. So in summary, growth is a big input. Don't let it overwhelm you. Don't put the onus of certainty on your shoulders. Make your best estimate. Use all the data you have. But remember again, you can't endow companies with high growth. They have to earn it.
Okay, everyone. So that was the first video on estimating growth. And I didn't really make it clear, but I'll send you guys some notes after class and also screenshots of the important, clips that he was showing us. So then that way we can talk about his valuation techniques a little further. And so without saying any more, we're going to start the terminal value video.
These last few sessions, we talked about how best to estimate discount rates, cash flows, and growth. In this session, I want to focus on a fundamental point that we all have to remember when we do valuation. All good things come to an end. What are those good things? If you have a high growth company, it can't keep growing at those rates forever. If you have a company with great products, those products might not stay great forever. This session, I want to talk about closure in valuation, how we bring things together at the end. And you have two choices. At some point in time in your valuation, you can assume that your business will end and that you will liquidate and sell it for what it can get on for the different assets. The other is you can assume that the business will continue beyond that point in time. It's called a going concern or a terminal value. That number creates more mischief in valuations than any other input. In this session, I hope to put some rules in place that will keep that number from running away from you. So we've talked about cash flows, we've talked about discount rates, we've talked about growth rates. We have one final piece in this puzzle that we've got to get in place for valuation to work. We have to put some closure on this process. What I mean by that is you can't estimate cash flows forever, right? The value of an asset is the present value of its expected cash flows over time. But what if you have an asset that potentially could last forever, as is the case with a publicly traded company? Since you cannot estimate cash flows forever, at some point in time, you've got to stop. But you can't give up on cash flows either. And what most people do is estimate what's called a terminal value. So that's the role a terminal value plays. It's that number that you're using as a bookend to capture what will happen beyond year 5 or 10, or whichever year you put the terminal value in. So what I'd like to do actually is talk a little bit about the approaches used to estimate terminal value. And broadly speaking, there are 3 approaches that are used to estimate terminal value. In my view, one of these 3 approaches should never be used, but it's actually the predominant approach that ends up being used. Here's the first one. At the end of year 5, year 10, year 15, you can shut the business down and sell off its assets. That's called liquidation value. When I value private businesses, that is pretty much how I estimate terminal value almost all of the time. Because when the owner ends a business, that's pretty much what happens to business. It gets sold off in pieces. The second alternative is to assume a going concern value, which is to assume your company will keep going after year 5 or 10, but that its cash flows will grow at a constant rate forever. You're saying, what will that do for me? If your cash flows grow at a constant rate forever, you have what's called a growing perpetuity. Again, you might wonder, so what? If you have a growing perpetuity, you have an infinite series. Now, this is becoming a mystery. An infinite series in mathematics, we know the answer to. We can actually solve the value of an infinite series. That's pretty much what happens when you have a growing perpetuity. You can write an equation that captures the present value of all cash flows beyond that point in time if you're willing to assume that your cash flows will grow at a constant rate forever. That's a going concern value. Liquidation value and going concern value are both legitimate ways to get a terminal value. So I've given away the game. Here's the one where you should never use to get a terminal value. You shouldn't apply a multiple to year 5 or year 10 numbers, an EBITDA multiple or a revenue multiple or an earnings multiple. What's wrong with it? If you do that, you're really not doing intrinsic valuation. You're doing relative valuation. You're using a multiple. Your multiple is way out in the future, but it's still a multiple. People who use relative valuation to get the terminal value and claim to have done a discounted cash flow valuation are really presenting a relative valuation in what I call drag. Those cash flows in years 1, 2, 3, 4, and 5 are distracting. They're distracting because they're distracting you from the key number used in the valuation, which is the 8 times EBITDA used to get a terminal value. So the next time you see a discounted cash flow valuation, check out the terminal value. If it comes from a multiple, call it what it is. It's a forward relative valuation. So your choices are liquidation value or going concern value. So the standard approach to estimating terminal value is that going concern approach, where you assume your cash flows grow at a constant rate forever. That's a very convenient way to estimate terminal value, but it can also get you into trouble. In fact, when you look at valuations, the number that usually gets valuations in trouble is the terminal value number. So I'm going to introduce 4 very simple rules to keep your terminal value in check, to keep it from running away with your valuation. First check, make sure that you don't exceed the cap. What am I talking about? Remember, in a going concern, terminal valuation, you assume your cash flows will grow at a constant rate forever. That growth rate, we said, cannot exceed the growth rate of the economy. But that leaves you with an estimation problem. You don't know what that growth rate is going to be. So here's a proxy you can use for the growth rate in the economy and as a cap on your terminal growth rate. Use the risk-free rate. Think about what goes into risk-free rate. There's expected inflation and an expected real interest rate. Think about what goes into the growth rate of the economy, expected inflation and an expected real growth rate. I think the risk-free rate is an excellent proxy for the nominal growth rate in the economy. But even if you don't think it's a good proxy, I still think it makes sense to use it as your cap on your growth rate. And here's why. If you think the risk-free rate is too low, your cost of capital is too low, right? To compensate then, I'm going to force you to keep your growth rate low. It keeps your valuations in sync. So use the risk-free rate as the cap on your growth rate. That's the first rule. Here's the second one. You have to make a judgment about when your company will become a stable growth company. My advice, don't wait too long. I've seen discounted cash flow valuations where people wait 20, 25, 30 years to put their company to stable growth. That's extraordinarily long. And here's why. If you look across the history of the US market and you look at growth companies, about 99% of growth companies have growth periods less than 10 years. In fact, the median growth period for a high growth company is about 3 to 5 years. I never use more than 10 years as a growth period in my discounted cash flow valuation. And if you're looking across companies trying to decide which company should grow for longer and which shouldn't grow for 5, maybe 6, 8, 10 years, here are some of the things you should look at. One is look at the size of your company relative to the market that it serves. If you have a large company in a mature market, Toyota, for example, don't get carried away. Where's the growth going to come from? Use a shorter growth period. If you have a small company in a huge market, Whole Foods and groceries, for instance, you have much more leeway. You can allow for a longer growth period. Second, look at recent growth, not in earnings, but in revenues. Revenue growth rates give away the game before earnings growth rates catch on. So your revenue growth rate last year was only 5%. Be wary about using long growth periods and high revenue growth rates. And third, remember, it's not growth that creates value, it's growth with excess returns. The stronger and more sustainable the competitive advantages your company has, the longer its growth period can be. So do some strategic analysis of your company. Third step in the process, think about excess returns. What am I talking about? I'm talking about the return on capital you think your company will earn in perpetuity. Remember, that return on capital is going to come under downward pressure from competition. So one of the issues you have to examine in terminal value is what kind of return on capital you're going to give your company, and it's a big decision. And here's the number you should compare it to. You should compare it to your cost of capital and stable growth. If you assume, as some analysts do, that in steady state, stable growth, you cannot maintain competitive advantages, then the logical assumption is the return on capital should go to the cost of capital. The excess return should go to zero. If that is the case, it doesn't matter what your growth rate is. Your terminal value will be the same whether you 0% growth, 1% growth, or 2% growth forever. If you set your return on capital above your cost of capital, and you might do that for some companies with really long-term competitive advantages, then your growth rate will still matter, but not as much as it would have if you hadn't brought the return on capital down. My rule of thumb with return on capital and stable growth is for 80% of companies, I go to the default. The default is, as I said, it equal to the cost of capital. For 1 in 5 companies, where I think that the competitive advantages are large and significant, I will leave the return on capital above the cost of capital by maybe 2 or 3%. That gives these companies an advantage and a higher value. Last piece, when you make your company a stable growth company, give it the characteristics of a stable growth company. In other words, if you have a beta of 2 and a high cost of capital during your high growth phase, that's okay. But when your company becomes a stable growth company, I would expect to see the beta move towards 1, maybe see it use more debt in its capital and a lower cost of capital. Your company cannot change in terms of growth with everything else remaining intact. So in summary, when you look at your terminal value, make sure your growth rate is capped. Make sure you're putting your company into growth at a reasonable point in time. Make sure you're thinking about excess returns in perpetuity, and make sure that you're giving the company the characteristics of a stable growth company. If you do that, your terminal value will stay within your control.
Okay. So everyone, pretty much just to wrap up today, I'll send you guys the notes. I also wanted to tell you why I think it's important, why we cover earnings growth and terminal value. So if you continue to watch Professor Damodaran's videos, the way that you think about valuation is when you arrive at a number, do you agree with that number? Does that number make sense? Is it close to other analysts, their values? And if it's not, why is that? I don't want you guys to just think since you arrive at a number with valuation that it's automatically correct. I'm sure you all already know that, but Professor Damodaran provides different insights and reasons why he disagrees with conventional valuation techniques. So thank you again for participating in this class.
All right, so getting it started on currencies. I know that last time we sort of touched on market indicators, right? Things such as CPI reports, employment reports, and so on. That's some of the things that we focused on in the last module. But in this module, it's mainly going to be oriented towards currencies. So things such as obviously money, exchange rates, and things of the sort. So that's essentially going to be the main focus for this class. And additionally, you'll see that there's some overlap, right, with the past module. There's going to be talks about interest rates, right, and inflation, and those are things that we touched on in the market indicator module. So this is somewhat going to be sort of a continuation, or maybe a module where all those past things are sort of emphasized more here. So as I sort of mentioned before, the class is going to be, this class specifically is going to be oriented around exchange rates. What are going to be the drivers of currency in terms of what's going to maybe increase a currency relative to another currency, right? Those are some of the things that we're going to analyze, and also hedging currency. And in this section, right, we're going to be looking at how do these estimates, how are they analyzed, right, going forward? Oh, I have Jay Hearn. I'm trying to get rid of that light. So it's sort of awkward.
Application, nice.
Okay. But yeah, just sort of to recap what I was just saying. In this class, we're going to be looking at things such as exchange rates, drivers of currency, and also we're going to see how estimates, right? How estimates in terms of exchange rates, how are those things calculated in terms of their historical values, and also looking at some functions using Bloomberg that will give us insight as to what analysts at investment banks are currently forecasting. So those are just going to be some of the things that we're gonna look at today. And just to get us kicked off in this module, what Bloomberg sort of said in the beginning is that to emphasize
60.
trade and to emphasize
Source if you can.
hello?
Which one? Source?
Not, can you okay, whatever. So essentially with this graph, you can sort of see the transformation of trade, right? So what is it? Import is the outer rim, right? So import represents where my cursor is, and the exports represent this, where my cursor is. So this is going to be the exterior rim. So of course, knowing the United States, right, we know that it's primarily an import based economy, right? And this being why they have majority of they're going to have more imports than exports, right? But also something that should be emphasized in this chart is, the difference between, the main trading partners and how the years sort of play into that. So, this is what we can see in 2016, right? We can see that the main trading partners are mainly going to be, countries like China and Mexico, right? And this was as these are numbers for 2016, but if we look at if we look at 1986, we can actually see that the main trading partners for the United States was actually Japan and Canada. So essentially with this, right, just emphasizing how things can change over time, right, in terms of trading, and also the dynamics of exchange rates and currencies. If a country is importing, bond, yeah. If a country is going to import product from another place, right, they're going to be purchasing that product, and they're going to be using the currency of the opposing firm, right, or the opposing country. And subsequently, also, if a country is exporting, right, they're going to be exporting and they're going to be paid in their currency, which means that the other firm will have to trade that currency. So again, it just sort of emphasizes those dynamics and how those can change over time, right? 1986, the main trading partners were Japan and Canada, and 2016 it was China and and Mexico, of course, yeah. So just to go more in depth with currencies, like who trades them, why are they significant? Financial investors, of course, they exchange currencies even when they're investing in assets that are overseas or from another country, right? They're going to have to go through that exchange rate process. Additionally, 45% of the volume in foreign currencies is driven by banks, security firms, and institutional investors. Over corporations who conduct businesses overseas, right? So they will use currency exchanges, and lastly, travelers use it. So I think a key function in Bloomberg that you can sort of use is the FXC function, which will give you a sort of a list, if you can, so to say, of not a list, but just an exchange converter, an exchange rate converter. So if you're curious as to how much a currency is sort of worth in a different country, right? Those are all things that you can sort of check out using that function through Bloomberg. And and just I'm not sure if y'all were able to see that past chart, but just to make it clear again. And these were actually taken using that ECTR function in Bloomberg Terminal, and these are actually pretty interesting, and these could be used, currently as well. So just some neat stuff that Bloomberg sort of offers. Now, additionally, in terms of currencies, you're going to be able to. There's sort of two main approaches, right? There's going to be pegged currencies, which are currencies that. Well, pegged currencies occurs when one country locks its exchange rate to another currency, right? And you might think, oh, well, currency, and especially currencies that float right with the market, those are determined by supply and demand. However, when you peg a currency, or when a country pegs a currency, what they do is that they build up FX reserves of which they can then manipulate the supply and demand for a currency, and thus they can sort of keep it at a fixed rate instead of it floating with the market. So just some background on that, as well as the US dollar is actually the most used currency for FX reserves. And using the peg function in Bloomberg, you'll also be able to see a list of pegged currencies throughout the world. So that's something to keep in mind. And we can see here in this chart, this represents the Argentinian peso in relative to the US dollar. So as we can sort of see, from 1992 to what I think early 2000, it was pegged to the American dollar, which means that essentially one Argentinian peso was equivalent to a dollar, right? However, in the early 2002, because they couldn't no further defend their peg, the value of the peso reduced dramatically. And in this line graph, you can see the amount of 1 peso, what that buys in terms of a dollar. So Argentinian peso per dollar, and you can see, right, it was equivalent to a dollar. And then of course, when they couldn't defend their peg anymore, it reduced dramatically. And something interesting here is because Argentina had so much debt, and because they were their debt was denominated by US dollars, when their peg when they couldn't defend their peg rate, subsequently all their debt was more expensive because now they needed more pesos to buy and to cover their United States denominated debt. So that was just a neat example that was showed in the modules, and shows that dynamic, right, between currencies and pegging a currency and a country and getting its currency. So sort of as I mentioned before, when looking at the currency market, of course, there's going to be pegged currencies, but also currencies that are not pegged are considered floating currencies, and those are the ones that are not going to have a fixed exchange rate, so to say. And using a Bloomberg terminal, you'll be able to use the FXTF function, which will give you a list, right, of all the unique currencies in the world, and which was something interesting, right, that was sort of mentioned in the module. I forgot the specific amount, but it was a ridiculous amount of currencies that are available there. So really just goes to show you just how much currencies there really is in the world. But additionally, using the FXC function, right, this is where you'll be able to see these floating rate currencies and these floating currency rates, right? This is considered a matrix. So essentially, when reading this chart, it gives you a lot of insight, right? But to begin, the way you would read it is in the amber column. Essentially, it just shows you how much. Well, the number right here and corresponding to the title of the currency in the amber column, that sort of shows you how much of that currency you need to buy a $1 amount or one currency amount of any of these currencies, right, of these different countries. So an example of that would be sort of this. I think this is SEK is the Swedish crown. So essentially, you would need 8.84 Swedish crowns to have $1, right, or to exchange for $1. This can sort of be highlighted, right? If you ever get lost looking at this map, you can just look USD. Of course, they won't put the dollar here because $1 equates to $1 in the United States, and when you go further in the matrix, these black boxes sort of represent that. But this is sort of this actually leads to a interesting perspective or idea that Bloomberg market concept sort of talks about, which is triangular arbitrage. So essentially, what they're saying with this is, let's see. So the specific definition of triangular arbitrage is it's the result of a discrepancy between 3 foreign currencies that occur when the currency's exchange rates do not exactly match up. These opportunities are rare, and traders who take advantage of them usually have advanced computer equipment and or programs to automate the process. So what they're saying with this is, and they actually give a neat example in the modules. They say, say you have an individual, right, who might have 88,400 Swedish crowns, and say they want to exchange that and say they want to exchange that for British pounds, right? So they would just do the simple exchange rate using this matrix where they would say, okay, 8,400 divided by the exchange rate, that gives you 7,740 British pounds, right? Then say he wants to go to US dollars, right? Say he wants to go to the US, or he wants to take a vacation over there. Well, then he would exchange that using the exchange rate, and then thus he would have $10,000. Okay, and then say he wants to go back, right, to Sweden, and he wants to exchange again. He goes through uses the matrix, right, uses the exchange rates on the matrix, and then uses that exchange rate. And then he ends up having the same amount that he started off with, which was 88,400 Swedish crowns. So this was just an interesting concept that was sort of highlighted or emphasized by Bloomberg market concepts, which, if you were to try to take advantage of these things, you probably need great software, right, or good programs to sort of take advantage of these discrepancies, because otherwise they might not be as materialistic as you would want them to be. Because again, right, this is a rates matrix, which sort of implies, right, they're going to move dynamically and sort of move in tandem with each other. And this is actually something I remember seeing some articles on, websites such as like Investopedia, right, that also highlight it and go more in depth. And it's actually a pretty interesting concept because again, these are floating rates, right? Go with the market, not fixed, such as peg currency. So seeing that dynamic is definitely interesting. Yeah. Additionally, the main drivers for a currency, or the main key drivers for a currency, it's mainly going to be changes in interest rates, changes in inflation, and changes in trade. And sort of how I highlighted before, things from past modules, such as the modules on key economic indicators, right? That's where we saw employment reports, CPI reports, things of the such, which sort of play into this, right? Because now we're talking about interest rates, inflation, and also trade. So interesting seeing how those things are sort of correlated. But to start off looking at this graph, this highlights sort of I'd say sort of the impact, right, interest rates can have on a currency. So with this, I think from early 2006 to about midway 2008, the European Central Bank raised interest rates, right? And one thing we know about interest rates is they're sort of going to be reflective upon things such as fixed income securities, right? Things of the sort. So if an investor knows that they can get a high yield, or interest rates are very high in a different country, they might feel inclined to sort of invest in it. And what would they have to do? They have to exchange their currency for the currency that's for the opposing currency to get to receive that security, right? So that's sort of just an overview of how those things work together. And when interest rates went up, right, when the European Central Bank pushed interest rates up, we actually saw that the US dollars per euro strengthened. So essentially what this means is that, more US dollars, you needed more US dollars to buy a euro. So what does that tell you? That tells you that the euro strengthened, right? Because you would need more currency of a dollar, or more US dollars to purchase just 1 euro. So this is just emphasizing that that connection between the two, right? And subsequently, when rates dropped, the US dollar per euro dropped as well. So that's just emphasizing once more, right, the relationship between interest rates and currencies. And it makes sense, right? If an individual wants to purchase a security in a different country, they're not going to purchase it with their own currency. They're going to have to exchange it for the opposing one. Sorry. Secondly, looking at trade, that's another key currency driver, right, that I was sort of mentioned before. And in this graph, we sort of see a graph of the price of oil, right? And then the white line sort of represents the number of US dollars per Russian ruble. So with this, just some context behind the chart is, Russia is a huge exporter, right, of oil. So this is where the trade dynamic comes into play. So in late 2008, demand for oil reduced dramatically, and subsequently what happened to the price, right? It fell as well. So when you don't have that much demand, when Russia didn't have that much demand for one of their key exports, well, now they didn't have individuals purchasing the oil in their currency, right? So now you can start to see those relationships. And what happens when that demand went down and that the demand for that trade went down, that means that the ruble relative to the US dollar, it weakened, right, tremendously. So, and that's essentially what the white line represents. It's the number of US dollars per Russian ruble. So that's just another graph that sort of highlights, the relationship between the two, between trade and between currencies and sort of exchange rates. And this was sort of something that I mentioned in the beginning, right, when we saw that those two circular graphs that highlighted trade between different countries, imports and exports. If a country is going to import, right, they're going to buy from an opposing country, they're going to buy that product. They're going to have to buy it in the currency of that opposing country, right? They're not going to buy it with their own. So that's where you're going to see that that exchange happen in real time in terms of a business transaction. Next, we'll be looking at Bloomberg had some key sections regarding estimates, right, and models. So they essentially distinguished between two of them, right, and sort of said that there's two forecast models that you can sort of use, and the functions will be FXFM for this this foreign exchange rate forecast model that's using historical data, and FXFC, which uses analysts' estimates, analysts that sort of work on investment mix. You can sort of you can imagine. So that's how they sort of separated the two. But currently, what we're looking at is the one that's going to be based off of historical data, right? And of course, already seeing that they apply standard deviation. They're going to be using certain assumptions, right? And this is what you can sort of see in this forecast model. We can already see sort of this looks like a normal distribution, right? Things that we sort of learned in our stats course. But essentially with this, they gave us a little situation that sort of highlighted how we could apply it. So, let's say a firm, right, a Euro-based firm, they get $100,000 in revenue, right? But it's denominated in US dollars, but all their costs is in euros. So obviously they're going to have to exchange, right, that $100,000 and then take into account that exchange rate so that they can have it in euros, which is where they're based in, right, the firm. So what you would do is $100,000 divided by 1.36, right, which is the exchange rate that we're currently using. That gives you $73,500 euros. And to get the profit, you just use your revenue, you subtract your the cost, and that's your profit, right, in euros. However, say like if you're a firm and you're iffy, right, about the future, you want to make sure that your outlook looks right in terms of your bottom line, using these forecast models, it's definitely going to be convenient for you, and you're definitely going to want to do it. Because if we look at the next slide, right, let's say that the price, right, the exchange rate is 1.40, right? So this means that the dollar will weaken, which is what they receive their revenue in. So essentially for every dollar, if the dollar were to weaken to 1.40, you would get €1 for every $1.40 in comparison to the past one. So you're going to need more dollars to buy €1, which means a weakening dollar, right? So how does this sort of look like when you apply that exchange rate? Well, now you do $100,000, right, divided by 1.40. That will give you €71,500. You subtract that by your, we'll use your revenue and you subtract that by your cost and you actually get zero, right, in profit. So sort of shows you how important, right, these exchange rates can be. And when using this forecast, right, how you would read this or how you would interpret it is, say you're looking for what the main one that they use is end of quarter one of year 2014. So essentially, they're saying that it's probable, it's 72% likely, right, that rate will be between 1.31 and 1.40, right? Now, let's say, sort of as we sort of mentioned before, what happens if we go through that we arrive at that rate? Well, if we just look at it sort of as a normal distribution, we sort of interpret these lines as one standard deviation, right, from the mean. We can sort of already start to consider our outliers, right, or our tail risks. So something that you may do is, you might do 100 minus 72, 72%, 100% minus 72%, which equates to, I believe, 28%. 28, okay. Yeah, so you get 28%, right? You divide that by 2, right, because you're taking into these tails, and then you get 14%. So you can sort of interpret that as that's 14% chance or risk that you're taking that the exchange might be more than 1.4, and that can, of course, give you a lot of insight as to whether you want to approach it a certain way or not, right? At the end of the day, this is a forecast, and it's there to sort of serve you and to sort of give you more insight in terms of what you should do going forward.
How far out did they go?
Yeah, no.
Because Europe is leading so much.
Yeah, this was like 2014.
At 116 today.
Wow. Yeah, that's crazy. Yeah.
I'm curious if they went out, they probably don't go out 7 years, right?
No, I doubt it, but again, and that the function to use is FXFM, right? And if you want to use the analyst estimates going forward, that's going to be FXFC. That's going to give you forecasted value, analyst forecasted values of currency pairs. Now, lastly, another thing that the module sort of touched on is the value of gold. I think they refer to it as sort of the storage value of gold. So, we know gold as not being correlated to any other assets, and subsequently it's something that you want to have, right, in terms of inflationary environments. And also it's a non-yielding asset, which means that it won't pay you a dividend or a coupon either. So these are some things, of course, that they emphasize throughout the modules. But, something interesting that they sort of mentioned is that if you were to have, I think it was in 1970, 1 ounce of gold costed about $35, which is what sort of they stated. If you were to just purchase that ounce of gold, right, what would that sort of be now? The white line represents that amount of 1 ounce of gold. It'd be about $1,249 dollars. While if you were to just keep that $35 and let it grow and compound with the CPI, it would only be worth $214. So something that they emphasize there is the storage value of gold, right? It could definitely be used, right? And I'm sure that this is sort of already heard, right? It's a general idea that gold, in terms of inflationary environments, that might be something that you'd want to look at because of its risks. I'd say it's just its risk evading features, so to say. So, and that's lastly, right, something that they touched on. And then at the end, Right, these are some of the key functions that they use throughout the modules, which I think were supremely interesting, especially the interactive trade flow map. Really gives you a bigger picture of how different countries are sort of trading on who's going to be their main partners in terms of their imports and their exports, whether a firm's importing more than it's exporting, and so on. So these were all pretty interesting.
So I think the last place that we left off was on picking ratios. I don't think were you here?
That's my first time.
Okay, cool. I know you were here last time. We were picking ratios last time. Right?
Yeah.
Okay, cool. So I think that I'm not necessarily sure how many we want to have. I definitely think that with it being real estate, I think that vacancy rates are going to be important. I think gross margin is going to be important. I think we need to find a few turnover ratios that are relevant, more relevant to real estate. I think that'll help out as far as picking out specific companies. And then I think that's going to be the gist of it. And then I also,
You might have to do operating margin instead of gross margin. I'm not sure all real estate companies, you have a lot of NA on gross margin.
gotcha.
It might be operating margin.
I'll bring
Yeah,
it up.
gross margin, I don't know what a real cost of goods sold is for them. An operating margin, or even if it's dollar margin, like. A lot of times operating margin and the dollar margin are the same. You know why you
Stepping up high, logging on. That can count.
No, well, shouldn't be, you know.
Is it the same time? You wouldn't do it.
No, because that's online. Green account. So.
Cool. Yeah, no, if it does, a lot better.
It makes sense for us that you want to add all that depreciation back. Here you might just give it, you see 1, 2, 3,
Hold on. How did that change?
You should get a number for everybody on the job market.
Oh, well, I changed the name on it because I didn't want it super long, and then it gave me like a slightly different number for each one.
Yeah, I always use it the job market. Yeah, you're just
Just
gonna
do that. So we'll take out gross margin.
So you want something, yeah, you don't need that. And then that's.
And then
Yeah, you won't, so the way you're doing it, you have something related to revenue growth, something related to margin, something related to return on capital, something related to risk. And when you use all of those, predict some relative value. For you, you probably want to use EV and those. So you just have to see what you can get. So what do you have related to revenue? So if you go over to the right, the vacancy rates are good, but you have so many NAs, it doesn't, you can't really use it in the model. You have to use it after you get the model results. So revenue growth doesn't make that much sense for real estate, but it's all about rents.
right.
So I don't think asset turnover makes sense for real estate because it's a strange animal. But let's start with real estate.
Let's see what they have on the property.
Why don't you just get a model run? Let's try asset turnover. Unless it's a little strange. So let's just try a regular asset turnover. Yeah, that's Excel. You might, yeah. Maybe at the minute you can email your spreadsheet out to me. or, you know, y'all can create it yourself, you might, you can sort of scratch this.
Yeah, well, I have one, but I just can't.
Oh, okay. Well, you know, get it set up and then Jabari, you can show them what you actually have, so let's.
What about debt?
Well, debt is a good one for real estate, so you can certainly do debt to the dog. No, struggle with that with the dogs, they have a negative value. So do you use net dog debt or total debt? So I guess net debt's fine.
Okay, let's see.
It really is.
No, it's back in front.
They got there. Oh, 60, we have to call them.
Okay, there it is. Okay, cool.
We got a gap. So I don't know that one, we get on that one.
Why is it
Yeah, it's part
doing
of the struggle.
Happens a lot.
Well, with 60,
There we go. Okay.
they're saying.
And then we
It's
did.
not, it's only a fixed, unless they call them, I'll have to call them, but two of these are doing that. That one, in fact, I'm to come back to this one. That one was. Yeah, that one right there was working before. All right, so you got a risk number that works. Asset turnover, you got a margin number. So you need some kind of return on capital. I think return on invested capital works well.
I think that works good for real estate.
Pretty common term, and it's easy to find in numbers. I think that type the entire, you can try ROIC, but you have to type the whole thing.
So what I'm thinking here, like on debt for REITs, is that like you want to ratio between 4 and 6? The ratio above 6 to 8. That ratio below 4.
All right, well, let's see, let's look at the data and see what's that.
Which
And they say net debt too, so that's what you're using.
which ratio is that? Oh, the net.
What website is that?
Yeah, return on invested capital works.
Yeah, look at negative numbers there, but that's. Okay. All right, so what are the four things that you have? Then you have the net dollar margin, you have net debt, you have asset turnover, and you have return on capital. All right, so you got four numbers. You want to take those four numbers and try to predict the valuation. So go over to the valuation and call them in, and we'll put that in comment.
Okay.
So try to see if there's an EV to FFO. What's your FFO? So the key is FFO include that or interest expense or not. If it includes interest expense, you want to do price the FFO. Might even just type FFO and see what comes up. What choices you have. You want something to FFO. Go down further, show more fields. Price to FFO, there it is. No, not the
Right
best, that one there, yeah, so it must be, all right, so that's saying, no, if it's price to something, then interest expense is subtracted, if it's EV to something, interest expense is subtracted. So FFO must be net of interest expense, so it's price. Because EV includes the debt, so if you're subtracting out interest expense, you don't want to, we need some NAs there, right?
Yeah. This is diversified. It works for the REITs, it looks like. Most of them at least.
How many NAs do you have? Oh, wow, a bunch in all in one area.
Yeah. So what, hold on, because these are all the same from, that's real estate development, real estate services. So it looks like it works for REITs for the most part, most REITs at least. Yeah,
Try price to earnings and see, I mean, the traditional REITs. Why don't you, I can tell you what, FFO is really close to the dog, it's just as important. Why don't you try EV with the dog?
Okay.
I think you can work from all sides. Did they have a price, something?
They have EV into best EBITDA. Oh,
No, just do the EV to the dot. I don't trust the best. The best is Bloomberg estimates, so I don't know what they're estimating. Yeah, try that.
well, that's
It should just be one that says EV to the dot.
periodic. If you,
Well, you want the one that has a 12-month in it, so not the average. So
I do the enterprise value.
You got okay.
That's the try. That's the try.
Right. So copy that over and place it in. Just take it over and get rid of it. All right, and then bring your formula over. Oh, you're okay. Yes, bring the formula over.
Oh,
Yeah. Okay, copy that down. Let's see if it gets rid of the NAs.
yeah. It does. Well,
You're
there's a few
gonna have some
sporadic-
NAs just because they're losing money. So if they're losing money, no, they don't have it. Okay, so y'all see what we have?
Yeah.
Did you get logged in?
Yeah,
All right. Yeah.
Cool. So should we take out the vacancy rates for now until we get the?
Yeah, I remember this type was called, don't do much with them. Or you could take them out, but I would keep the title somewhere, so you just can reference them again. And they're probably not that hard to find.
I don't know.
Let's try model, and if it works, maybe next week you can rewrite the press, and then see what you do.
I'm gonna,
Practice, so you want something, you're gonna do a model, you want something related to turnover, something related to margins, something related to return on capital, something related to risk, and then your evaluation, you can use the first four to predict the fifth one. So now what you gotta do is go through and get rid of all the NAs. Anything that has an NA on it, that we got rid of.
just this entire one. Yeah, because they're negative.
Probably got
They're
rid of-
negative if it after return too. So
Kind of depends on the ratio. Anything related to earnings.
yeah,
Get rid of the- right. You can click on that, delete button up at the top right. Over to the left.
oh, there's not a lot of them.
Now, I've seen two approaches. Some students, some groups, are like NA is subject to the zero part, but not necessarily. I think it's better just to get rid of them. I forget one team with the lead. The company are really interested in, I don't know what it was, something like Beyond Meat, something like that. Sometimes.
Yeah, that's it. That's all.
All right, so add 2 rows at the top. Have y'all seen them all?
No.
We do pretty simple, so add a couple rows at the very top. Click on the 1 and 2, you get over on the left, or the click on 1 and 2 and just insert. Click it right there.
No, no.
Sorry.
Hi.
Y'all can see them on Zoom if you're on Zoom. All right, so you want to walk me through the process? Or you click on the number 1, not on the number 2.
No, wait, wait, wait.
So, on actual 1, click on the 2 there, and put it there.
Okay.
So what we're going to do is go to the right over in O3, go over to O3. Do equal. Click on J3. So you get your title in there, copy that over. Yeah, perfect. All right, and then in O, what we're gonna do, O4, do equal, what we wanna do, we want to figure out where every company ranks in all these ratios. So equal rank, open parentheses, and click on that 38.1 in the first company, and hit a comma, and then click on the 38.1 and do Control Shift down. Make sure you're on the 38.1. Control Shift down. Put your F4 twice. Yeah. And then comma 0. 0 means 5 numbers are good, 1 numbers are bad, and then put which numbers you enter. You copy that down, across, either way. All right, so that first company is 121st.
And then we can.
All right, so the only thing I have to change now is on column O, instead of comma 0, no, not comma P. In column P, do comma 1 instead of comma 0 because higher is worse there. Copy that down. All right, so you have how many things? 1, 2, 3, 4 items. All right, so O2, type O2, not 4, O2, type 0.25 for 25%. And copy that over. Yeah. Yeah, okay.
All over.
Just, yeah, not in the current EVA one. But yeah, and then in R1, do equal sum and add those up. So we're going to start equal weighted. We're going to change it a little bit. Sum those, that should add 100%. All right, so here we go. So in T2 type, or T type weighted. And the next line, type fundamentals. Type fundamentals. So our weighted fundamentals, so let's look at this first company. They do really bad on EBITDA margin. They're really low on debt, which you're saying that could be bad, right? But we'll assume that that's good. They're pretty good on asset turnover and they're really good on return on capital. So what you can do is the equal sum product. And then highlight the 25% and hit your F4 just once, comma, and highlight that first company that's 121 to 111 all the way over. So what some products doing, not the 40, just the 18. What the sum product is taking 25% of 121, 25% of 11, plus 25% of 26, and 25% of 18. So we're going to average weight ranking. So if you hit enter, that firm's average ranking was 44. They're also the 40th most expensive. So it looks like they're appropriately priced. All right, so you can copy that down. Now we'll see how horrible or good the model is. So up in T1, do equals CORREL, sorry, open parentheses, and highlight S4 all the way down. Control Shift down, comma, and then T4 all the way down. We're probably going to get a really bad number. We'll see. It's negative. That's pretty bad. That means it's a horrible model. So can you get this model any better? So click on the word data up at the top. Solver. Have you already solver before? Solver is wonderful. Okay. All right. So let's show what we're going to do in solver. What we want to do is get that bar square, that correlation as high as possible. Right now it's actually negative. So what we want to do is maximize that correlation. So we've got negative. It means our models are really bad. It means companies we think good are really cheap, and the companies we think are bad are really expensive. So it means our model is the exact opposite of the market, which is one for company. All right, you want to change those 25%, so highlight the full 25%. And you want one constraint, so add a constraint. Get that word add. And you want that 100% in R1, you want that to equal 1. from the equal. Take that out. So you have to do it.
Right here.
That equals 1. So, okay, so y'all see what we're doing? We're gonna change those 25%, see if we get a better model. So you'll hit solve and let's see what it does. Okay, how high do we go? It's still negative, though, right? So you have a horrible model, so we gotta find something that's better than what we have here, so it's a horrible model. Real estate's unique, so what we have to do is find other ratios.
That work
You're
for the
in-
model.
You're in Bloomberg, right? Up in Bloomberg. You might jump over to Bloomberg and kind of what you're doing on this page. Bloomberg has something similar. So if you type FTW, Bloomberg, something called factors to watch and find real estate. So not all sectors, find real estate. See over here, it says highlights. Let's try profit. FTW. We did the margin, right? Operating margin. Everything's about margin. There's one that had their average 3-year EBITDA margin. That's something you might do. So did you do real estate there?
Yeah, I clicked on real estate.
And then under highlights, click on highlights,
Yeah.
the style and view profitability. A little bit lower over here. See that word highlights,
I'm blind. Can't see.
right here.
Okay.
Click on that. And let's try profitability.
There it is.
Yeah. And what Bloomberg's telling you is basically what ratios are most highly correlated to valuations.
This is telling us the ones that are most important to pay attention to.
The most highly correlated, you already got the first one. So what you might try next week is to bring more of those in and see if one of them gets the allocation. If you go back to your model in Excel, what did it actually allocate to? You put it all in the EBITDA margin, you can see that's what company says is the most important, and you're still getting a negative. Go back to Bloomberg and let's, instead of doing profitability, see if there's one related to relative value somewhere. Earnings, yeah, that might try earnings.
There's 5-year. Okay.
I mean, you might look at some of those and just try them and see. Some of those 3-year ones, I think, kind of interesting when you look at how they look over 3 years, especially because you're taking data right out of COVID. So you've got messed up data anyway, you know. So, book by war zone, yes. They're saying earnings yield is the most important. That's probably true. You might either look at earnings yield if they have a dividend yield in there. That might drive dividend yield because that's really important. But essentially, you know, there's something to think about between now and next week because we're running out of time. But to think in terms of what other factors you can put in there. So your first model was pretty horrible, but you ran a model. And this week you ran a model, you got something there. Now the key is to start adding other factors. I've had some teams that they just take every single one of those and put it in the model and let solver decide. That's kind of a cheating, that's kind of data mining kind of thing, but you can do that. You just write down, you know, maybe write down the top 10 of every single one of those FTWs. And you just put every single one of them in the model. Because once you get the ranking, it's a matter of copying over, right?
Well, there's a lot of just different types of margins involved. I'm realizing that.
Well, and there's a lot of overlap in those, like EBITDA margin, operating margin, are practically the same thing.
And their returns are about the same.
Earnings yield might be something to bring in there. Earnings yield to me is nothing more than the PE ratio upside down there. So, you know, the PE ratio is price to earnings, earnings yield is earnings to price. I'm not sure that'll be more. So essentially all you do is you just start adding columns and adding other data points. And that FTW is a good way to do it. That website you found is another good way to do it. See what we're talking about. Yeah. Probably one related to return on capital or something. And then, yeah, that's pretty much all the way. I don't know what else I can. Growth, yeah, that's a good deal. Growth. EPS growth, yeah. Positive EPS orders.
What was the one that you were saying? What was it? Huh? Yeah. I thought I put that one.
You have it, yeah.
Yeah, we have that too.
You could try instead of it, Bloomberg has a default. So let me show you how quickly you can update this. So go to the debt one. And to the right of the debt one, well, okay, you added 2 columns, right? All
Yeah.
right. So maybe delete one of those columns. I just want to show y'all something. So in that column K, do Bloomberg, go up to Bloomberg and find fields and type the word default. Find the 5-year default probability. Apply and close. Right, and then go over and add a column between Q and R. So click on the R, click on the R, or the Q now, sorry, and insert, and then copy the entire column R over the Q. So that automatically brings that in. Cap rate is a really good one to use, and yeah, I don't know why that didn't work. That should have worked. You don't want to do. Let's look at it real quick. Oh, you didn't bring the data in yet. Go over to J. I thought you had it. You did have it in there. So drag that over and copy that down. Oh, yeah, we never brought it in. All right, copy that down. All right, now copy R all over the Q. They're really small numbers. Yeah, go over to R. Click on the R. Control C. Control C. Enter. All right, now you can rerun solver. You might talk about this thing, just rerun solver. Why do you have that now? I have to go down and look at the new value. You go down and just look. You hit enter and just go find where the value came in. There it is. So, wow, that's strange. You got a value there. Okay, get rid of that company. You have to click on that.
Just throw them out.
It's Paramount Group. Right, that might be it. Go back to your first query. Go back up to your correlation. See.
Killed.
All right, so now rerun your model. All you have to do is do data solver and go. Okay, so.
Should this be changed to T-Row? Oh no, it's still.
Yeah, it automatically updates everything when you insert it. See how much better that helped? So why does that default work? Because that is really important, but it's one of many factors they use. And so Bloomberg's like, look at that, plus 20 other risk things. So you've already got your model positive, that's pretty good. How's some factor using how you found on this stuff? What did you say? You said the cap rate? You must try cap rate, you must put that to the right of, since there, insert. Make it some NAs on the cap rate, though. That's pretty important for real estate. Your higher or low is better. So well, the choices that they give you.
Implied cap rate, life cap, current interest rate.
Yeah, probably implied. Probably won't get as many NAs that way. See how many NAs you get. Very first one. Yeah, you're getting too many NAs on that one. You can try a different cap rate and see. You just click on L3, you don't have to delete it, just click on L3 and go back to Bloomberg and find field.
Oh, and it'll just,
I think it's automatic update cap rate again. What other choices did you have? Don't really have many. No, the rest of those don't have anything to do with real estate. You can do cost of debt if you want to instead. That's kind of, or you can do the try instead of cap rate. Do I tell you what? Instead of cap rate, let's do EVA spread. So it's WACC EVA spread. Yeah. And as you get there, wow, look how many negative numbers there are.
everybody's.
Boy, everybody is negative. There's one positive in that whole thing. Well, try that. So again, all you have to do is go over to the right and add a column wherever you added the column here. So it's between what and what? Default and debt. So I'll go over and click on this. Insert a column. And then copy the formulas over. Or yeah, copy all T over, Control C. This one. All right, we run solver and see if that does anything. That's kind of close to cap rate. White EVA is going to look at actual return minus the cost of capital.
I brought it up. There we go. 0.42.
All of your numbers are in. Oh, wait, though, you got a problem there. Is when you do EVA spread, it's got to be comma 0, so it's going to mess it all up.
It's probably wrong.
You want EVA to be higher, so that one, yeah, it's going to take it back down. And that's the thing that's saying firms is really bad. EVA spreads are the ones we want. So that doesn't make sense. So when you rerun it, it's probably going to go back.
It is negative. It's negative.
Well, no, but rerun solver.
Oh.
It's going to put 100% back on the default. All right, I'll see the process now. So now the key is go out and find ratios that apply to real estate. And start adding them. You see how easy to add it to the model when you set up right?
Yeah.
You can try operating margin. You can try or just even WACC by itself. Internal assets. The other thing I think is really valuable are the ones that are over time. So growth in earnings over 3 years, those can work sometimes. Save that model and you kind of have to keep going out for them so they can see.
So once you get into Bloomberg and all those pop-ups are gone, we should be able to have like a screen like this. So we're just gonna type in the same index we've been using. So the Russell 3000. So if you just type in array, it should pop up under securities right here. Should be the first one. You're gonna tap that, and then we're looking at the company. So we're gonna go to member weighting. Click that. Have all the stocks we're looking at. So since we're focused on our sector, we're going to go here and type in GICS and then go to sector name. Click that, click enter. Oh, click it and click enter. And then it should pop up with the sectors. And then we're going to go back one time, click GICS. And we're going to do, let's do industry group now. I think that would give us like a smaller, it'll kind of classify the stocks into smaller groups, so we don't have to deal with a big sum of stocks right here. So we're gonna click that. We're gonna go. Do one. Let's do sub industry. Yeah, see which one. Right. So we're gonna do all 3 of those, and then once we get that, we should be able to export it to Excel. Cool. Okay. So what I like to do is sort this. Let's sort it A to Z. So we have our consumer discretionary right here. So what I'm gonna do is, so it's a little bit cleaner. I'm going to delete all the stocks that aren't consumer discretionary. So start here, 126 and up. One 26 and up, we're just gonna delete it. If you have questions, let me know. I'll stop so that everybody. Let me know when y'all are ready, or if y'all have any questions. So now all we're just doing is clearing everything out. So all the only stocks we have are the ones with the sector consumer discretionary. No, not yet. We're gonna do that right now. Actually, I'm trying to think of which sub industry I should do. I do retail. And once you find like the place where the last consumer discretionary is, you can just press Control Shift and then up or down, depending on what direction you're trying to go. And it'll highlight everything underneath or on top of it. You can just right click and delete it. Everybody good? Oh, we probably. Maybe delete the one. So you know, part of that shows that because you have the other ones too. So those yes, yeah, please say oh, but you have to say it. Yeah, it's not and you same thing as you yeah, so you can know that if you want oh, you did actually really say you already got what you have. Yeah. So everything else, you just delete everything.
think it's smart. You get the same problem with
Were you able to get something like this too? Okay, cool.
Oh. So what are we doing? He's got the same issue, so let me check on how.
Okay.
So we thought.
So have you sorted the consumer discretionary part? I'll come over there. I got you. Yeah.
So what that's something with the city road shit. So anytime, so you log in this weekend, it should already do it. Exactly. It's a system there. Yeah. You didn't have to repair it. All right, so we start by the API diagnostic. No, you already did. That might be sorted again, so. That would be good, right? Yeah.
So, okay, so you can click the button. Click C. And then sort wheelchair. And then take. These right here. Yeah, cool.
Yeah, I think everybody's caught up. Yeah, all right, cool.
So after you sort the sub-industry names, so I think today I'm kind of hungry, so I'm gonna do restaurants. we'll work on the sub-industry group restaurants. So what I'm gonna do here is same thing I did when I was deleting the other ones. So I'm just gonna go to 295. I don't know if it's the same cell number for y'all. It should be around the same range. So whichever. So the first row that doesn't have restaurants, just Control Shift up, and then hold Shift, and then make sure it doesn't delete this top row, and then delete those. And then do the same thing, but instead of up, just go down. So Control Shift down, and then delete those as well. And then we have all these wonderful stocks right here. And then once you get to this part, we can pretty much delete column F, G, and H, because now we know everything here is a restaurant. And then, I don't know, some of y'all might not have these columns. I left them, but I don't think everybody has this. You can delete those, and then you can delete C, D, and E too as well. And when y'all get here, just let me know. Or if you have any questions, let me know too, and then we'll go to the next part.
I'm just thinking.
I'm hungry. There's one on campus, but it's closed. I think that's what Bloomin' is too. It's one of those like they own like a bunch of other ones too. Yeah. So is everybody good? Yeah. All right. Cool. So now we're gonna click this on the top of the toolbar. We're gonna click Bloomberg here, and then find fields. So with restaurants, I think personally, I could be wrong, but I think a good important an important field to consider would be sales growth. See how much they're selling over time. So we'll do sales, and then we'll do type in sales and 5, and it should show 5-year average sales. The second one, so click that, and then I would say, you think gross margin would be a good one too? Gross margin. Okay.
I'm worried about the first one.
The first one.
I'm about to see. You might bring in the next one just in case you need one. I'm just concerned that the sales 5-year average would be the dollars. 5-year average.
You think it? Okay.
5-year average flow. I think you try that again. You have 2 of them.
Okay. So do both the growth one and the average one?
Yeah.
Okay. Cool.
It's dollars. It's not helpful that much. Just in case.
I think it is growth because that's the one I've been using before actually.
Yeah. The first one's just every dollars.
Yeah. Let me delete that first one. So we're looking for the one that says 5-year average and then growth. And then we're gonna add in gross margin. And then, okay, what would a restaurant? Okay. So EBITDA. So the 5th one. So EBITDA.
Yeah, that one are large, yeah.
And then,
So if you think about it, it's sales, margin, return on capital, and risk.
okay. So should I do ROIC on invested capital or?
Yeah, return on invested capital
Okay.
or return on equity. Return on invested capital is a good one.
Okay. So we're gonna do return on invested capital and then debt to.
Yeah, or default ratio.
Yeah, the default ratio from Bloomberg is a good one, right?
Yeah, because it becomes some stuff.
Okay.
A lot of trouble.
I'll do the.
We did that with real estate, and the only one that had a correlation.
So the 5 years is probably the best one because it's longer, right?
Yeah.
Okay. So we'll
That's the
do,
highest correlation.
okay. So we'll do 5-year. So if you type in default, and then you should click the 5-year default probability. Then these 5 should be good for now. And then we can always add more later on too. But it's a good starting point. Then, oh yeah. Is it this one here? So it's gonna be this one, the first one? Okay. So it's gonna be EV to trailing 12-month sales. So we have 6 different things, and we're gonna click apply. Then close out of this, and it should all pop up in our spreadsheet. So if you're like me, like I hate seeing like half of a cell. So I just highlight it and then double click in between, and then all of them kind of autofill. Except this one, but it's okay. So once everybody's here, let me know. Or if you messed up in between the two steps, let me know. You good? Good.
Cool. Yeah, once you get copied on the fly, that's one thing, one word should change is when you hit apply.
It goes away, right?
Go away. Good for once, I mean, going to be good. Not actually.
So cool. So once we're here, we're going to use the Bloomberg function. So we're going to click equals BDP, parentheses, open parentheses. And then we're going to first click our first company. Then we're going to anchor it. We're just going to anchor the column. So we're going to have a dollar sign in front and then comma. Then we're going to click the field, the first field. And we want to anchor it across so that we can just fill this equation all the way across. So we're going to anchor just the row. So you have the dollar sign in front of the one. And once you click enter, it should pop up. And then what I'll do is double click down and fill it across. That's awesome. Then just to make sure your formula is correct, usually I just highlight a random one and make sure that it's analyzing the right thing. So should be good. And then once y'all get here, let me know. And if you have any trouble in between those two steps, let me know too. You got it?
Yeah.
Okay. Did you get it too?
What's
So I'll show you right now.
yeah.
So put that and then put
Oh, man. You don't want it on like something then.
Yeah. The first time I did it, I think I messed up. Like, I don't know what I was doing, but
Yeah, some companies will have data, so you can do it.
yeah, that was actually my next step. So this is actually one of the better ones I've had. I only see 3 NAs, or actually 2, because this company has 2 of them. So we're just gonna delete Krispy Kreme. Yeah, sounds good right now. So I'm just gonna delete that one. Actually, let's do this. I'm gonna click this one and then control and click 21 too, and then let's delete both of them at the same time. And then if I double check and zoom out, should have no more NAs. That's pretty cool. And then another thing I like to do too, so just highlight C through H or whatever columns are yours, to do that and then go home and then click the comma right here. So we can get rid of all that extra dump numbers that we don't need.
Yeah.
What happened? You good?
Oh, I don't know.
Dang. I don't know Wingstop is totally trading my bicep. I'm just hungry. You're good? All right, so the next step here. So the first week we did a regression, but we kind of found that once we like throw in debt, it kind of messes up our intercepts and our slopes. So we're gonna try this ranking model. And we're probably not gonna be able to finish it today, but I'm gonna make sure to save this one this time so we could come back to it because I lost it on it last week. So right here, we're just gonna insert like maybe 2 or 3. I'm gonna do 3. So I'm gonna insert. I'm sure there's a function to do that. I just don't know. And then right here, so we're gonna rank our first field, which is sales, our 5-year sales growth. So I'm gonna type in rank and equals right here. And then we could copy that across. So copy that across so that it has all the. Actually, get rid of that for right now. So I just said equals and I equaled the cell that has the field number. That way I can just fill it across and not have to retype in everything. It's kind of easier way to do it, save a little bit of time. And so what I should probably do is make this one. I should probably bring this down. Everybody able to get it? Oh yeah, I can just fill them across too. Okay. So here's gonna be the fun part. So now we're gonna rank them based on like to see which one's like the number one of each field. So with sales growth, we're obviously looking for the number with the highest and gross margin as well, and EBITDA, and then return on invested capital. But for the default probability, we probably want the lowest number to be the highest one. So we're gonna have to tweak our formula a little bit for that column, but for the rest, they should be pretty much similar. So we're gonna go here equals rank, parentheses, and then we're gonna highlight our first cell, and then comma, and then we're gonna highlight the whole range. So it would be C5 to C37 for me, and then whatever your corresponding range for y'all is. And then here, and then I can't remember. I think it's 0. Yeah, the dollar signs, right? So in order to so that we can just fill it across, I want to say it's anchored this one.
That one's gone. The 5 and the 37. You don't see this. That way when you copy across, you go down along to C5, C6, C7, C8, they're always against triangles, 27.
And then we move it across, it should be able to the other ones. Okay. Okay, cool. So we click enter. So I think this is McDonald's, the first one. Yeah, McDonald's is ranked 28 for self-drug. So we'll fill it down. And then number 1 here is, should probably freeze my page. Dave and Buster's. I went there last year. And then we should be able to just fill these across if I did it right. Okay. And then once y'all get here, let me know. And if you have any questions, let me know as well. So what? Not just because, yeah, it's good idea we did it, that's why. Yeah, so we need to read the whole. If you want, just highlight the whole thing, that way it's good. Quick save. All right. Oh. Yeah, we do that. I think if you want, you can go read that and then read it, right? But also, yeah, that was. You got it. Yeah. Cool. And then for this last field right here, the default, we're gonna change that last number. Instead of 0, we want it to be 1 because we want it to be the lower the number, the better it ranks in our little ranking model. So we're gonna just change that 0 at the end for just that column to 1, and then we're just gonna fill it down.
Copy your L with the.
You said what?
You can copy column L with column L. You're gonna need to rank this easier for me, so.
Oh, okay.
Just copy that L.
Okay. Okay, it's not filled. Okay. So as you can see here, like, let's open this up. Let me actually do this. C4. To make it a little bit easier, I'm just gonna click here, C4, and then click view, and then freeze panes. That way, if I go all the way over here, I'm not doing it right. Oh, I freeze it vertically. Cool. That way, if I scroll over, I can still see what stock is which. And I probably should have done that H4. Let me fix that. My bad, y'all. I'm gonna click H4 and freeze just the first column, and then scroll across. That way, once we get more stuff to the right, we'll be able to see the stocks and see what we're looking at. And then, as you can see, like for here, so when we rank our EBITDA margin, McDonald's is first, and they're first in the default probability too. So they have a low probability of defaulting, as you see, it's 0. And it looks like there's other companies too that have a 0% chance of defaulting because.
Well, it's not 0, it's just, I don't think that's why you might change the percent.
Okay.
Yes.
Let me do that.
And Bloomberg is not consistent. Most of the time, Bloomberg, I think it's 20% on, they multiply by 100. For some reason, they don't multiply by 100.
Okay, so like this one, McDonald's has a 0.29% chance of defaulting in comparison to the rest of these. And then it looks like right here, Tasty, I think. Let me see what it is. Carol's Restaurant Group. Never heard of it, but they got a pretty solid probability of defaulting. And then,
Oh, yeah. You know, there's investment grade and below investment grade. Investment grade, like the triple B, single A. The below investment grade, double B would probably be 5 or 6%. The 12 is like a single B. 12 is really high. Double, a single B or a super one, like, over 5 years.
on the rank or just the regular?
On the rank,
Yeah.
It's on the rank.
Oh, the last number, it should be a 1, right? Okay. Nah, you're good. And then let's okay. And then let's see what other stuff we can take out of here. So the gross margin, our number one company is, let's see what that is. Dave & Buster's, we already talked about that. And then they're also number one in sales growth too, which is interesting. Because I don't know what they're selling, but let's see. But yeah, so like these ranking models are kind of helpful because you can kind of see in comparison to like, I guess, when you compare all similar stocks in a similar industry, you can kind of see where they rank in different aspects. So like sales growth, one company may be number one here, but their return on investment capital may be low. So that's something to take into consideration when we're considering to like add them to our portfolio or maybe even short it. So I think that's kind of interesting. So we'll probably just stop here because we only have like 4 minutes.
Okay, so we're going to start with some charts and graphs. So let's create a new tab here. So we're going to click this plus button. And wherever that sheet comes up, let's drag it over here to the right. And we'll just start it well over here to the right. And don't let me go too fast. If you have any questions, slow down. So you can hit this plus button right here to get a new sheet, or you can right click and hit add new sheet. And then you just click on it and you drag it around if you want to move it. So we'll move it to the end here. All right. And now let's type in growth rate into B2. And we'll type in cost of goods sold, or COGS, which is how much it costs to sell our stuff. We'll do our growth rate as 10%. And then next to cost of goods sold, we'll put 7%. Or we'll put 70%, sorry. So down here, we're going to write revenues, which are also known as sales. And we're going to put cost of goods sold under that, because revenues or sales minus the cost of how much it costs to sell those goods is the first part of the income statement. So we're going to write our years here. We're going to start with 2020 and then hit tab, which will make you go to the right and do 2021. And once you've got those first 2 years, highlight both of those years and get your solid black line here on the bottom, and let's drag out. You can tell you where it's going to say, drag out the 2025. You can see right here underneath it, it says 2025. So that's how you know how far it's going to go. So with revenues, we'll start our revenues at 100 million. In 2020, we sold $100 million worth of product. And we're going to increase those by our growth rate of 10%. So all we're going to do here is type our equals. Everybody caught up so far? Anybody, I can definitely don't mind running over there to help you. We're going to do equals C5, which is our revenues, and we want to grow it by 10%. So we're going to do times, which is the little star, open parentheses, 1 plus, and we're going to do our growth rate of 10%. Now we want that 10% to stay the same as we drag that over for the year. So we're going to hit our F4 button, which can put dollar signs in front of our C2, which is going to lock it into a place. We call this making it an absolute value. Doing good so far? All right, then we close our parentheses and we can drag this over. Let's drag it over to 2024. And that's going to increase by 10% each year. If you want the numbers to be a little cleaner, highlight that. Click on this, which will bring our decimal points over to the right. Now our cost of goods sold is going to be 70% of our revenues. So in this box, we're going to type equal revenue times, so equal C5 times our cost of goods sold, which is 70%. And then we want that 70% to stay the same as we drag it over. We don't want to get all those empty spaces in row 3. So we're going to hit F4 again, which is going to lock that 70 in place. So the C5 is going to drag across, and that the other one is going to be locked into place. So if you hit enter, we can see 70% of 170. Now, as we drag this across to 2024, our cost of goods sold is going to increase relative to our revenues.
Can you backtrack a bit?
Yes, where are you at?
At the calculation part, like from revenues.
Sure. So you can see right here in D5, it's equals the beginning revenue times 1 plus the growth rate. Are you able to hit F4 and those dollar signs come up?
Oh yeah, I'm typing it right now.
Okay.
Two. Okay, I got that.
Perfect. And you dragged it across like this?
Yeah. Can you hold on a second? Let me retype that real quick.
You getting it over there, Larissa? It's okay. It's okay, no, it's the same number. This is different graphs. Once you graph it, it's okay.
Okay. I've got a question. So for that one,
Say that again, Jay?
yeah. So is it C5 times open parenthesis 1 plus dollar sign C dollar sign 2 close parenthesis?
Yes, that's correct.
When I did that, I got like exclamation mark.
You have an equal sign in front of it?
Yeah.
I can't see your screen. So maybe you can just watch while I do this. And then maybe me and you can talk about it afterwards. Does that sound okay?
Okay.
All right, I'll definitely walk you through it at some point later tonight or maybe tomorrow, okay?
All right.
Well, let's just watch right now so we can get through some of the stuff.
Oh, by the way, does it work the same on numbers on Mac?
There's the numbers should be the same. There's a couple little differences, but it should work out to be the same. But yeah, no, Mac, I don't have a lot of experience on it, so it'll be a little bit different.
Oh, okay then.
All right, so for the revenues in 2025, let's just type in, we know that there's a meteor coming in 2025, so meat revenues are going to be down at 90 million. And our cost of goods sold are still going to be up because we're still going to have a bunch of costs. So we'll put 95 for 2025. Okay. So this is the start of an income statement, what we're actually going to be using in the real world. So we want to see this in numbers. If I just select these top two rows right here from B4 down to H5 and go over to insert, go to recommended tables. It's going to show me exactly some options here. I like this bar graph. So if we do that and just hit OK, you can resize it right here. But that gives us a good idea of what our revenues look like. They've been going up by 10%, and then 2025, they drop a little dramatically. So
Bond, can you go to cell C6 and C7, please, or D7?
sure.
Thank you. D6. D6.
Yes.
Thank you. I'm good.
All right. So if we click on our chart, charts have different elements. So as you click around this chart right here and I click on revenues, you can see that revenue selects. If I click on this axis right here, just that axis selects. If I click on the other axis, if I click on these bars, I can select these different elements. If I want to take things to and away from the elements, I click on the plus sign right here on the top right. And I can take away the accesses. I can take away the title right here. I can, with the title, I can center it. I can move it above the chart, and there's more options. With these data labels, I'm a big fan of these data labels. If I click on that, it's going to tell me exactly what the information is. And if I click on this little arrow here to the right, I can tell exactly where I want them. If I want these inside the column at the base, called out on the end. I like the data call out when the numbers are a little bit better formatted. So we'll do this outside the end here. It just allows us to see what we're working with a little better. So error bars, grid lines, if we want just the grid lines in the background or not. A legend, it tells us what bars are what, and the trend line tells how things are trending, if they're going up or down. Different types of trend lines. So those arrow bars out to the right definitely make a big difference. So if we want to add more to our graph right here, we can just click on the outside of the graph right up here on the left. Highlights this information. If we were to drag down right there on B5, we can add more stuff to our graph real easily. You can see that cool feature, how easily we can bring things into the graph. So let's look at some different types of graphs. We want to go over to, again, to insert and go to recommended charts. Let's do a line graph. Again, you can resize it by moving this around, and you can pull it around when you have this arrow crossing here. So it's a lot of good sometimes to get multiple charts and line them up side by side, and multiple companies and multiple industries, and you can pull in and make charts very quickly. You want to change the title, just highlight. All right. I'm gonna let you start kind of copying some of this data. And we're gonna start graphing it. So if you want to do when you do the year, just type 2015 and 16 and then drag down from here, and that'll fill in up to 2021. And we can just start with the attendance. So don't worry about these 3 columns here. Just do the year in attendance. So pretend that you were a teacher and you were teaching 2015 through 2021, and you're teaching an Excel class for the Investment Society. And in 2015, your average attendance was 2 people. In 2016, your average attendance was 12 people. 2017, you had 17 people, all the way down to 2021 when COVID happened and you only had 2 people attending. So once you got those numbers in there, we're going to show the school board what our attendance has been, because we want to get more financing for it. So you can highlight everything. If you click Alt F1, it puts in whatever table you have as your default. So that's a good little trick. If you want to make a line chart your default or a bar chart your default, that's a good way to do it. But just hit exit or delete or backspace if you want to get rid of that. I'm going to go over here to insert. I'm going to go to recommended charts again. And it has, I like that line chart as our first one. So go ahead and grab that line chart. And we can see 2015 started low, went up, went down, and then back down for 2021. If we want to move some stuff around and change any of our numbers, right click, or let's do it this way. Up on your toolbar here, it says chart tools. You got 2 tabs, your design tab and your format tab. This is going to be all for your chart. So if we want to change chart type, we can real easily go from a line chart to, a scatter plot to a pie chart, and that'll translate any of our charts real quickly. Let's see. All this formatting, just a cool way to make it pop, to make your chart stand out if you needed to show it to somebody. The format here, if you want to change any shape outline effects, add some shadows, some glows, kind of just make some of your stuff look cooler. There's a lot of different ways to do it. So if we want to change any of this data down here, we can click on either one of our axes. Let's go click on our x-axis. And once you've clicked on it, right click and go to format axis. And over here on the right pops up something that allows you to control almost everything you're going to need on your chart. Everybody caught up? Anybody have any questions so far? So this is a really good thing to go into and to play around to know what Excel is capable of doing. So if you want to change your bounds, change your dates, change, add accesses to it. Let's see. Now that we have access titles, we can say this is people. And say this is the year. All right. Now let's add some more stuff to it. So our attendance was actually this. Let's add our gold to it. You type gold and put these numbers in. Once you have those numbers in, click on your chart again. And you can just move over this highlighting, and it's going to add our goal to it. And the chart updates automatically. And then we can look at, see if our goal met our expectation of actual attendance. We'll go ahead and make a whole new chart for when we add in our competitor. So type in our person next door who's also teaching the same class. We're trying to get more students to come to our class than his class. He's had these numbers 4, 6, 8, 10, 12, 21, and 6. So we're going to move this chart down here and start a new chart with our competitor. We'll do recommended charts. And I'm enjoying this these line graphs. So we can see our competition. These recommended charts already add our titles for us just because we highlighted them. So our actual attendance is in blue. The goal is this red. We've been above our goal in 2016 and 2017. In 2018-19, we dropped below our goal. In our competition, we were above our competition the first 3 years, and now it looks like lately our next door class has had more attendance than we've had. Again, let's add our last. We're going to compare ourselves to Professor Sweet's class, who's also teaching the same class. So if we click on that and then just drag this over for one more, here's Professor Sweet's class in purple, and we can see that he's smoking all of this with his attendance rates. So it's a really good way to pull information from a large source and actually get to see what it's looking like. Let's see if we can make any other good charts out of this. I'm gonna highlight it again. Recommended charts. Here's a bar graph. Here's a nice one right here. This is called a stacked column. We can see the totals. If we put out a total column, data labels, we'll put inside here. So that's a pretty good way to see who's getting what and who's going where. You know, Professor Sweet's hogging up most of the class time. But these charts and graphs are a real powerful way to quickly pull in data and take a look and see what's going on. So let's see. I think that's all of my class time now. 5:30, 6:15. No, I got 15 more minutes, correct? All right. So then real quickly, let's go to Yahoo Finance, open up Google. We're going to pull in a little bit of company information and graph it real quickly. What company do y'all want to graph? So go to Yahoo Finance. Let's do McDonald's. So MCD is McDonald's ticker. So just type that in real quick. Let's take a quick look at how McDonald's is doing over the last 6 months. They've been doing well. 1 year, they've gone from 206 up to 242. That's not a bad little COVID history. All right, so we want to get this information so we can graph it. So let's go to historical data. And this gives us the reason why Yahoo Finance isn't huge used by a lot of people. It just doesn't go back very far. It only gives us a couple years of data versus Bloomberg and Capital IQ give us much more data. But this is fine to use when you just want some quick calculations. So we have the time period, the historical prices, and the frequency. Let's for McDonald's, we can, if we click on max here, we can go back to 1966 if we want to. But let's not go that far. Let's just go back 5 years. So click on that 5 years, should say October 17th, 2016. And then on frequency, let's do monthly. So you can do daily, weekly, or monthly. And then hit apply on the right there. So we can see that our numbers are going back monthly for the last 5 years. And now once we've got that, let's go over here to download. That's going to give us our Excel page. And just like that, we've got 5 years of McDonald's history. I'm going to say cancel on that. Anybody have any problems with that so far? You got it over there, Larissa? All right. And Jay and Chan Wu, you're keeping up?
Yep.
All right. So this adjusted close column right here, that is the column that we're after. Yahoo gives us an open price, a high price of the day, the low price of the day, and the close, the price when the stock market closed. But we're going to use this adjusted close because it accounts for some of those other things that need to get adjusted for, such as dividends. So if you highlight from B to E here across the top, and then right click and just delete these 4 columns, that's going to pull over that adjusted close automatically. This volume tells how many shares there are. We can also highlight that and delete this column. All we're really after is this adjusted close. I'm going to make it look a little prettier, so I'm going to click on V2 and then hit Shift, Control, and down. That's going to highlight the whole column, and I'm just going to pull some of those decimal points over by clicking on this decimal point number right here. Gives it a little bit cleaner look. So I think we're going to graph this 2 different ways. So let's graph it just how it is, and then we're going to make an adjustment. So in order to graph it, highlight A1, and then Shift Control down and over. That's going to highlight everything. Let's go to Insert. This rundown on the bottom in the middle is a scatter plot. Click on scatter plot. That top left one right there should do it for us. So these are the returns of McDonald's over the last 5 years. And if we want to add a trend line, go down here. We already learned how to do this a little while ago. We want a linear trend line. So that line right there goes right through those returns of McDonald's. So just like that, we can get a view of how when McDonald's has been up and when McDonald's has been down. So we can change our dates a little bit. Let's click on the date, go to Format Access, go to Labels. How can I make the dates a little prettier, Professor? Just Format Access. Number? Oh, okay. So yeah, number.
Just type it how you want it on the type. Just type it how you want it. Just recognize it. You don't have to type over it. Just click on it and type over it.
Right here?
Yeah.
So we're just gonna put Y. And that just makes your date look a little prettier. If we wanted to add more dates in there, not that we would really need to. Okay, so now let's go back over here and take a look at. We're gonna make these returns a little bit more user friendly. If you do equals and cell C3, and then do parentheses B3 divided by B2, and then add 1 to that. Did I do that right, Professor?
Well, y plus 1?
So it should be -1?
Well, are you trying to return?
Yes.
Yeah, minus 1.
Not +1, -1. And then we're going to copy that all the way down to the bottom. And we're going to put it into a percent. So these are the returns that McDonald's has had. So we can see in 2016, from November to December, McDonald's returned almost 3% in that month. From December to January, it returned 0.7%. So let's see what McDonald's biggest month was. So if we go to equals max, open this, shift down, and enter, we can see in 1 month, McDonald's biggest gain was 13.43%. That's a pretty good month. But now let's graph these returns compared to this date here. So let's see, in order to do this, let's do Control Shift down. Do they have to be next to each other for me to graph it, or can I select both columns to graph?
Well, I've never had luck putting all three at once. So you can try it.
Let's see.
There's no way to control what you can do. I would just do.
All right, well, I'm not sure to do it, so we're just going to move over our adjusted close. So copy that, paste it over here.
You could do all three and then delete it in the browser.
Gotcha. That would be a better way. For now, we're just going to jerry rig it. So we'll delete this column, which moves over. Oops. No, it doesn't.
So you gotta cut and paste it. And then move over. Then you click on new and control text.
Let's do it the other way and then delete it. So we're going to select all 3 of these cells. And then we're going to insert recommended charts. There's a scatter plot right there. All right, let's do that first one then.
Yeah, pick that one.
So we got this line chart up here. Now we want to remove this adjusted close. So if we right click on this bottom here and go to select data, we can take this, we've got our 2 data series here. We've got adjusted close and we've got blank series. If you just take that adjusted close off of there, unselect it and hit OK, then that just leaves us with our returns. And now we can look at our returns over the years between negative 0.15% and negative 15% and plus 15%. So that's a really good way to get a visual of what our returns are going to be.